They say the best form of offense is defense. You can see that historically through all of the great sports teams, and it's a concept that traders really do like to implement or embed within their own psychology when managing trades. Now, as you know, common saying, 80% psychology, 20% skill, or your actual trades, that is what your trader is made of. Now, the psychology bit of trading is so important, and that's why we emphasize a lot of these videos on how to manage your psychology. And in doing so, we're trying to break it down into elements which are simple to understand, to put them in analogies such as, you know, defensive trading and how to think from a defensive point of view in really mitigating your risks and increasing your profits. As Warren Buffett said, the first rule of trading is not to lose your money, and in reality you've got to be in there to keep fighting for another day. So we're going to break down 5 key elements to the defense trading philosophy here. So the first point to discuss are lot sizes. Now, we've discussed this in a previous video about risk management, which we will link below for reference, but in theory you don't really want to be risking between 1 to 2% per trade. This is, for example, if you have a $1,000 account balance, $10, $20 is what you want to be trying to limit your trade out to. Even if you've got a bit more of a riskier appetite, or you like risk, you could think of increasing that, but marginally, knowing you have a bit of a buffer there in place to limit your losses. The reason why this is in place links up with a stop loss point here on number 3, that it really limits your downside risk, and your lot sizes in comparison to your account balance will begin to manage the psychology around your trading. So for example, if you've got a $1,000 account and you're trading half a lot, which is $5 per point move, the market moves 100 points, it's $500 in the negative, and you're down half of your account balance. So lot sizes are really something to consider when you're placing your trades. It's essential that you keep them small, especially when you start, just to get your feet wet, get you used to the trading environment, and help you to manage your psychology from the defensive point of view. It brings you on to a very interesting point next, and that's hedging. So what is hedging? Hedging is essentially the balance of your risk. And an interesting example is if, say, you're buying a market, could be any market, and the market's floating up and you're making money, but then you're holding on to the trade as the market falls. Now, you have a few risks here, the main one being your margin. So you could be running close to a margin call, or you just could be running a huge loss. So what do you do to balance your risk, given that you don't quite want to cut your losses and you want to keep that trade open? Well, what you do is you do a hedge. So you would sell the market here, and you'd buy the market here. So say you buy one lot and you sell one lot as well. So what you've done essentially is that you've equalized your outlay of risk, and the market could be floating within this level, but your overall equity remains the same. Now, people like to use hedging to, again, mitigate against big market moves, or should they wish to counter trade either trend, they could hedge the market. However, it is a key part of your defensive trading psychology to know that you can always hedge your trade out. So for example, if the market ranges, comes back here and takes out your buy, you can close out that buy in a profit, and then keep open your sell is still open, and take out your sell also in a profit. So there is a way in which you can take your buy and sell into a profitable trade. So that's very important in terms of thinking defensively, as hedging is always a facility you have open in order to mitigate your risks and manage your trades moving forward. third point, very interesting one, we've touched on this a lot, is stop losses. Now it's very basic, but normally the basic things people tend to forget, and it's a core element to what a defensive trade is. A stop loss. Essentially, you're mitigating your risk. You know exactly how much you're going to lose per trade and risking per trade. For example, say it could be 1 to 5% per trade. You have $1,000 account balance, and therefore you have $50 of risk at 5%, for example, that you're risking per trade, or $10 to $50. However, you know, and you've priced in your own defensive psychology when placing this trade, is that you're not going to lose more than $10 or $50 on any trade. And it's important that you do keep in mind these things when you're thinking defensively, because the idea, as I said at the outset, is to protect your account balance. That is your sacred bit of wealth that you're protecting and looking to grow, not to lose, of course. And these are things that you can implement to help you mitigate those risks factors. Fourth point, which is another interesting one, we haven't really touched on them in the whiteboard wizard episodes, but we're talking about partial closing. Now, partial closing, again tying up with point 5, but it's more taking profits off the table. You know, for example, this is a market and you're buying this market and you bought it around this level, market's going up and you're running into profit. You don't have a take profit in this example, but the market's going up. However, you really want to hold on to this position for a while. So what do? You do a partial close of your trade. Say you've bought this trade for one lot and you want to take half a lot away from it. So it's fantastic, and this facility is also open to you when you're trading, because what you've done essentially is you've taken half of your risk off of the table, you've banked profit, which is excellent for your psychology, and you're thinking defensively. You're still in the trade, you've got half of your profit banked, and you're there to fight another day, and you've got half of the trade still rolling for future benefits. So always think about partial closes, and if you don't know how to do this with your MT4 platform, you can also contact our team and we'll show you how to do some partial closes and trailing stops for that matter. So it's a very important part to consider within your psychology when you're thinking defensively. The fifth point, the final point in our defensive formation here, is withdrawals. Now, you can do this two ways. You can have a second account, which is used like a wallet account, for example, where you can place your profits in that wallet account, knowing that you're not going to touch that account, you're not going to trade that account, but that's there purely for withdrawal of funds, psychologically looking to put it in the second account, knowing, okay, I've banked profits, I want to stop and I'm going to transfer those funds into that account, or move them into your bank account. You have no idea how much of a magic feeling that it plays when you've actually taken out funds from the market into your own bank account. It really puts trading into perspective, knowing, okay, look, I've turned these funds into something tangible now, taking it from my trading account into my bank account. So always a really nice thing to do is to withdraw funds whenever you can. If you've got profits in there, take them out, send them to your bank account, and use that as a part of your defensive strategy, knowing that, okay, I'm diversifying my own portfolio, I've got funds in a trading account which are trading, may have a second wallet account which is holding some of my profits or acting as a buffer account, and I've got some money back into my bank account. So it's really an important part to implement in your trades, which you should really consider. So all of this is open to you for your defensive strategy. So by way of summary, we'll run through it again. Lot sizes, remembering to manage your risk, being consistent, tying up with point 3, hedging, knowing that you can also buy, sell to balance your risk and to manage your margin a lot better. Also to use hedging strategies to even try to make some money on these trades. Stop losses, again, another risk mitigator to help control your downside risk and to prevent you from losing more money than you initially planned to lose. Partial closing, taking off risk off the table, banking profits, putting it back into your bank balance. This is really essential for thinking defensively. Fifth point, withdrawing funds back to your bank account. Key part, very simple, I know, but getting back to basics. Exercising your right to withdraw. It's very simple, but do it. It really does help with your trading psychology and to help you to live to fight another day. That is what you want to be thinking. You want to be trading for the long term. You don't want to put $1,000 in an account, lose it within your first few trades and then stop trading completely. It is a long-term sport, more than a break-even sport. If you do it correctly, you follow the correct mechanisms for your defensive trading strategy, and you will succeed. Hope you've enjoyed this video. Please do like, thumbs up, subscribe, comment below. Any questions you have, please do let us know. Hope you enjoyed it. All the best.